Okay, what's up, everybody? This is Sunko, the Korean bro. Today is 2024, February 2nd. I looked through the chat of the companies that I invested, and the one that popped up was Meta Platforms. Meta Platforms were up 17%, and it's not only Meta Platforms, but like Shopify and like other stocks are going up as well. And let's see what news we have. And okay. Hmm. Okay, Meta flipped entire narrative and AI investment analyst. January jobs report. U.S. economy adds 353,000 jobs, blowing past Wall Street expectation. The U.S. economy created 353,000 non-farm payroll jobs in January, according to new data from the Bureau of Labor Statistics released Friday. More than the 185,000 expected by economists. January's jobs gains were also higher than December's revised figures, which showed there were 333,000 jobs created last month. Initial data out last month showed there were 216,000 additions to the workforce in the final month of 2023. Combined revisions for November and December added a total of 126,000 additional jobs compared to initial reports. So the unemployment rate also has steady in January at 3.7% for the third straight month. The surprise strength in the labor market helped consumer wallets too. Wage is a closely watched indicator for inflation and a gauge of how much leverage workers have in the labor market increased 0.6% on a monthly basis and 4.5% over last year. Economists had expected wages to rise 0.3% over last 3 months and 4.1% over last year. Some key metrics did decline though. The labor force participation rate ticked lower to 62.5%, down from a 62.6% the month prior. So while average weekly hours worked moved down slightly from 34.3 to 34.1. So the largest job increase in Friday's report were seen in professional business services. So which added 74,000 jobs in February, well above its 2023 monthly average of 14,000 jobs. Meanwhile, healthcare added 70,000 jobs and retail trade gained 45,000 jobs. On Wednesday, Fed Reserve Chair Jerome Powell described the labor market as at or nearing normal, but not totally back to normal. It's still a good labor market for wages and for finding a job, Powell added, but it's getting back into balance, and that's what we want to see. Recent data has reflected Powell's observation of a normalizing labor market. ADP's monthly price, monthly private payroll data released Wednesday showed the difference between annual wage growth for workers changing jobs and workers staying in jobs has narrowed to pre-pandemic levels. You're seeing solid pay growth, not supercharged but pay growth like we saw before. ADP chief economist Neil Richardson said on the call with reporter after the release on Wednesday. So the labor market has come into focus in the first month of the year as headlines of layoffs for many corporates have piled on. Broadly, economists haven't seen this trend appear in the data yet, though, and didn't expect it to play a prominent role in Friday's report. Hmm. At this point, we want to see strong growth, Powell said. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months. Okay, let's look at this one. Tech investors show their insatiable appetite this week. So, the years of cost efficiency being enough are over, and investors showered by gains from big tech are looking for more. Primed by towering expectations of an AI fuel transformation and narratives of relentless growth, the market is applying the same cutthroat logic of more with less. So, but instead of executive touting their efficiency to ick through a tough quarter, the shareholders applying the pressure for perfection. Stocks pop after jobs blowout take a windfall. U.S. stock futures pointed mostly upward Friday, but the index is dipped off high after a blowout January's jobs report served as last major data point in a jam-packed way of market-moving events. Hmm. Meta's brand new dividend will make you this much richer. Okay, you already could. Okay, let's see this one. You already could get rich holding shares on Meta platforms. Now a brand new dividend is just a bonus. The social media giant Thursday announced plans to pay its first ever quarterly dividend of 50 cents a share. That's an annual total payout of $4.4 billion, ranking Meta at 31st, the S&P 500 for total annual payout. Says Howard's Meta's dividend is also big enough to boost the S&P 500 yield by 0.74% to 1.46% from a 1.45 percent. He says, and that's on top of the stock's nearly 160% gain the past year. Hmm. Okay, first things first. Let's go to this one. Okay, Trade Magnificent 7 stashed with 45% to 84% upside in 2024, according to certain Walt Sultan Wall Street analysts. Okay, Tesla had a banner year in 2023, accomplishing what seemed unimaginable just a few years ago. The Model Y, the company's most popular car, drove to new heights, nabbing the title of world's best-selling car, according to online industry publication Motor One. What's particularly notable is that Tesla was the first electric vehicle to achieve this distinction. Over the long term, Tesla's goal is to increase vehicle production by a compound annual growth rate of 50%, but that would come with peaks and valleys. However, Tesla's forecast for 2024 sent many investors looking for a potential off-ramp. Management said this growth this year may be notably lower than it delivered in 2023, saying that its auto sales were currently between two major growth waves, while fair weather investors fearing the worst took shelter. Those with a long-term outlook stayed put. Despite the company's tepid outlook, Morgan Stanley analyst Adam Jonas remained the symbolic leader of the bullish camp, keeping on overweight rating on the stat with a top price target of $345, implying additional upside of 84% compared to Thursday's closing price. You noted that Tesla's outlook provided almost no new information and didn't specify what notably lower means. His models already factored in lower growth for this year, and there was nothing Tesla could do to stem the bearish tide among some investors. So, at roughly seven times forward sales, Tesla is relatively cheap in the context of its overall opportunity. But it's certainly a buy on any weakness. If the analyst view is right, and I firmly believe it is, Tesla's stock still has a long growth road ahead, even though the ride may be bumpy. 7 times 4 sales. Hmm. So the surprise development of 2023 was the emergence of generative artificial intelligence, which was a significant driving force behind the market rebound. The company best positioned to benefit from the secular tailwind is NVIDIA. It rose prominence by developing a graphic processing unit. So they rendered lifelike images, thereby revolutionizing the gaming industry. Parallel processing, or the ability to break up large, unwieldy computing jobs into smaller, more manageable chunks, helped make NVIDIA's GPUs the gold standard in machine learning, an established branch of artificial intelligence. It also made the company a shoe-in to adapt its software algorithm to take on the latest generation of AI. On the back of two successive quarters of triple-digit year-over-the-year growth, management expects the tide to continue. For its fiscal 2024 fourth quarter, NVIDIA is guiding for revenue of $20 billion, an increase of 231% year over year, driven by the ongoing adoption of generative AI. Another 76% from here. The analysts call the company's triple digit revenue growth unprecedented, saying the stock is just getting started. So Amazon 45% implied upside. It's not very often a company controls the top spot in two industries and is a leading contender in a third. But that's the case with Amazon. It's the undisputed front runner in e-commerce and leads the cloud infrastructure industry it pioneered. If that weren't enough, it's also world's number three provider of digital advertising. Those three business segments represent a strong foundation for future growth, which will likely be spearheaded by AI. Amazon has a long history of integrating advanced algorithm into its business operations. Amazon uses AI to manage inventory levels, its warehouses, map out delivery routes, and make product recommendations to customers on its website, among many other things. However, its greatest opportunity is providing AI to users of its industry-leading cloud infrastructure offerings, Amazon Web Services. The company offers a growing suite of AI models, which include its own. Despite a stellar performance in 2023, Radburn analyst Alex Hazel believes there is a plenty of upside ahead. The analyst maintains a buy rating on the stock and a price target of $230, implying additional gains for investors of 45%. He posted investors underestimate how quickly Amazon's growth will reaccelerate, arguing that the outlook for Amazon is exceptional. Even after soaring 81% last year, Amazon remains remarkably cheap, trading for roughly two times next year's sales. Given the potential for AI fueled growth and the rebound in its foundational business, investors shouldn't sleep on Amazon stock. So, okay, we got a lot of articles tonight, but I'm getting really, really tired tonight. So instead of reading it tonight, I'll just keep it and read it tomorrow altogether. Okay. See you and have a good night. At least I did YouTube for at least 15 minutes. So anyway, bye bye everybody.